Well, it is good to have you with us on this Thursday. Earnings and interest rates remain two of the biggest talking points in the market this morning, and we're going to walk you through more earnings stories in the next 2 hours. But let's start with the interest rate story. A week after the Bank of Canada indicated it's inching its way towards a dovish pivot, U.S. Federal Reserve Chair Jay Powell made it clear yesterday he's not in a hurry to lower rates either. Powell, while keeping current interest rates unchanged, said officials want to keep their options open until they see more evidence the inflation fight has been won. Now, for stock market bulls who are expecting a rate cut as soon as March, Powell seems to have closed the door on that. Our first guest this morning is a former Fed official who told us in December he thought the market was getting ahead of itself in terms of rate cut expectations for this year. Dennis Lockhart previously served as president and CEO of the Federal Reserve Bank of Atlanta. Dennis, it's great to have you back with us. Appreciate the time as always.
Thank you, John. Good memory.
We try. Keep you honest. Just in terms of your reaction to what we heard yesterday, what was it?
Well, I think I was a little bit surprised that they inserted the sentence in the statement and Powell gave such explicit guidance. But clearly, I think the committee is a little bit concerned about a kind of frenzy of anticipation around March, which they did not intend to deliver, or don't, at least the probability is they won't deliver it. And so they've tried to cool things down a little bit in terms of market noise and market discussion.
You know, it's interesting. I hear convincing arguments by economists all the time. Some who will say, well, if you've got a resilient economy and we've seen improvements on the inflation story, you know, there is some wiggle room. You've got others who say, you know, given the level of interest rates, we should really be trying to think about where we're going to go from here. And there's some notable risks at maintaining the current levels for monetary policy. So for Powell, kind of threading this needle of I guess, a soft landing. How's this going to play out in your opinion?
Well, there's no question that they're thinking about when to initiate a normalization process. I don't think they really anticipate at this stage that the economy is going to falter in some way. It always could, but I think they're thinking that they'll move through the year, and at some point they'll be comfortable with the inflation data and commence normalization. That will then be, in all likelihood, a very measured and deliberate march towards some notion of the neutral rate. So several rate cuts as they normalize. And so far, it looks like that scenario is workable. It seems to me the economy is cooperating beautifully. Okay,
so if you had to put your early guesstimate hat on how we should think about what happens to interest rates in the United States over the course of 2024, what would it be at this point?
Well, I think they'll probably get comfortable by mid-year if they continue to see inflation data that support the basic story that disinflation is continuing and it's on a track to 2%. So one of the mid-year meetings, I think they would be comfortable enough. And I have no reason to revise the 3 median that we saw in December, 3-cut median. I think 3 cuts by the end of the year probably is a reasonable assumption. It could be fewer, could be maybe one more, but I think that's a good base case at this time. The reality that sometimes is lost in the market, John, is the committee doesn't know. Because the committee doesn't have that good of a crystal ball what they'll be faced with at future meetings.
It's a fair point. I don't think anybody knows anything truly about what happens tomorrow. So we like to put our faith in people who spend a lot of time on this. But that is a fair point. Actually, on that point, since we never know what's going to happen, it felt like we had moved past some of the jitters in the banking sector, which obviously, you know, the Fed's got to, at the very least, look at the health of the financial system. And as we were navigating that Fed decision yesterday, people were also trying to figure out what's going on with a regional bank, New York Community Bank. It was a reminder at the very least of some of the loan risks in the market, some of the real estate risks in the market. How are you thinking about that side story and how it ties back to what, let's say, the Federal Reserve does?
Well, I think there's probably still risk in the banking sector as they face the major adjustments that are occurring in commercial real estate, particularly the office sector. And they're going to have to work through that at each bank level, what their portfolio revaluation has to be. That could be somewhat painful, but they've had a lot of time to anticipate it, and I'm sure every bank is working hard on this particular problem. If they can sort of make it a very slow process, or a process that doesn't have a major triggering event, then the banks will get through it, I think. There's also the question of their investment portfolios, many of which were heavily invested in treasuries. They got a wake-up call with Silicon Valley Bank to see what could happen, even with risk-free assets, if you have invested too long. And no doubt there's been efforts to try to protect themselves against that kind of event. So I think there's reason to be a bit more optimistic about the banking sector.
Dennis, just my final question goes further afield than the United States, only because here in Canada, we got a message essentially a week ago that the Bank of Canada feels that interest rates have peaked, but they're not quite ready to talk about cutting rates either. And I think because before we got the Fed decision, some people were wondering, with all that talk about a possible March rate cut in the United States, would it be possible that you'd see the Fed cutting before the Bank of Canada cuts? Maybe things are a little bit more aligned today. But for any central bank outside of the United States, how much do they have to be navigating what ultimately Jay Powell and his team do before making a move themselves?
Well, of course, they all are going to claim that they're independent and they make their own decisions based on their own domestic economies. But I think the reality is the dominance of the U.S. dollar in the global system, and the cost of dollar credit is such a major factor that they at least have to have their eyes on that. And those countries that are sensitive to foreign exchange rates very clearly have to be aware of the differential in interest rates between countries. So there's a tendency to sort of track the Fed in some respects.